Special coverage from the New Orleans Investment Conference is brought to you by Victoria Gold Corp, leading Yukon's new gold rush.
Welcome back to Soar Financially. Welcome from New Orleans, from the New Orleans Investment Conference, day 2. And I'm joined by Keith Weiner. He's the president and CEO at Monetary Metals, and you're also part of the Gold Standard Institute. It's great to have you. Thank you so much for joining me here.
Thanks for having me, Kai.
It's great. Yeah, no, we were on a panel together on Wednesday already. And I want to run through some of the questions we discussed there with you as well, because I think it was a really good discussion on gold as a monetary metal, but also sort of setting the foundation in terms of like, what's the economy up to these days, right? And I think we should start there as well. Like, Keith, what's your impression of the state of the economy?
So obviously we had a GDP print of plus 4.9%, and everybody's mystified by this. And the short answer is GDP is a terrible, horrible, at best, grossly misleading measure of the economy. GDP, and I put it in slightly snarky terms, is production plus destruction. Like we have the sign wrong on something really, really, really basic. So in a rational universe, if you go and borrow $50,000 on credit cards to go on a bender to Las Vegas, that should not be considered to be additive to your household income, household productivity, household anything. Yes, consumption. Yes, it's true. It adds to your consumption temporarily, and then it leaves you with a lower consumption for years or decades while you attempt to pay that off. The same thing is true if the government borrows not $50,000, but $1 trillion, in the last couple of months, something like that added to debt to spend on consumption. So yes, it adds to GDP. All of that goes into GDP, but that doesn't mean the economy is good. That means that GDP is bad as a measure of anything. And people should pay a lot less attention to GDP as a statistic that they quote.
So in your words, the economy is actually not doing that great as the numbers suggest, perhaps.
I mean, when you, and I liken it to, imagine a farmer in a remote frontier kind of place, lonely, bleak, but he's got X amount of land that he's got under tillage or whatever. And at the end of the fall harvest, he puts aside, he harvests all of his grain, he puts aside, let's say, a third of that grain, I don't know what the ratio was, into seed stock. He must never, 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 never eat that seed stock because that's what he has to plant next spring. And if he eats the seed stock and doesn't plant next spring, he will starve, not now, but next winter, right? Because he doesn't get a crop. So I liken it to, imagine if all the farmers in that town would have bust out the seed stock and have just a month of feasting in January. That adds to GDP, that adds to employment. It's very labor intensive. You have to take all that grain out and you have to cook it and grind it and bake it into various things, brew it into beer, whatever it is you're going to do with it. It's labor intensive, so it adds to jobs. There are companies that are getting revenues. What I guess you could call quality of revenues or quality of earnings isn't sustainable. And so am I trying to say it's all fake and that everyone is actually unemployed even though they're saying everyone's employed? No, that part is real. I don't think the government's cheating in that sense, but it's not healthy. Maybe another analogy would be, suppose you haven't slept in 3 days and you're just really, really, really tired. So you go mainline some crack cocaine. And then when that wears off, then you start on the meth. Okay, you're still awake. I mean, you can measure the person's pulse and consciousness with brain waves and all that. Yes, he's awake. He's walking around. Is that sustainable? Is that healthy? There's a whole different set of questions around that.
I think creating value or adding value with the money being spent, I think is a big problem. Like a lot of money disappears. We're not creating a lot of money, like the Infrastructure Act, right? For example. Inflation Reduction Act that was supposed to boost it.
That was the Orwellian name of Inflation Reduction Act. What are they doing? They're giving it to consumers to spend.
Exactly, right? So it's not creating that value that you're looking for. It's not forward-looking. Although, and that's maybe a counter-argument, is I've been discussing that as well. Like a lot of the CERP money apparently is still sitting in some of the bank accounts. It hasn't been all spent. Right?
It takes a while for some people spend it slower. Some people blew it immediately. Some people spend it slower.
Maybe you want to talk about lag effects. I think that sort of is what I was hinting at is the lag effects in the economy that we're seeing, because what you're saying, well, everything doesn't look great. And there's a lag before it really it hits the fan, right?
Here's one of them. And so on the panel, the topic came up about unemployment as a lagging indicator. It's true.
Yeah.
Okay. But how are people in the audience supposed to evaluate that? How do you reduce that to something concrete? And so sometimes, because I'm actually in business, I think about how this actually works from a business perspective. Now, my business happens to be growing. We're not, bound to the Fed cycle or anything like that. But if there's going to be this giant gyration of the Fed cycle where the Fed is alternatively pumping and starving, the economy, and you're a CEO, especially of a major corporation, you're just bound to this ridiculousness. And of course, major corporations have very high fixed cost. So when if revenues go down 10%, profits could go down 90% or 120%. So what you have to do, you have to play that game. You have no choice. And what you have to do is you have to do layoffs, in the downturn. But the key is to be the first to do layoffs early in the downturn, and then you're saving the most money because you lay off 6 months before everyone else, then you're saving all that payroll for that extra 6 months. And then as the thing begins to turn up, you want to be the first to hire and grab market share into what's going to be the next boom cycle.
Yeah.
Unfortunately, in addition to the cycle, what we've also had is a number of head fakes between 2000, I guess the first one would have been 2011, 2014, 2015, 2017, where it looked like we were heading into a downturn and employers did some layoffs. And the Fed, it's like training Pavlov's dogs with the ding, 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 ding. These companies got creamed because the Fed juiced up an even bigger, succeeding boom without really the bust that people were fearing. And so these companies then were forced to go back to the people that just laid off and say, please, would you come back? Please, we'll give you a big bonus and we'll double your salary and all this stuff. So they got burned over and over and over and over. So Pavlov's dogs are now trained not to do the layoff. But this one's a bit different than all those other head fake cycles. This one, the Fed has massively hiked, and they're still holding it high, and the damage hasn't worked its way through yet. And anybody who's holding off on doing those layoffs because they've been burned 5 or 6 times before is really going to regret it on this time. They're going to be on the wrong side of the cycle.
Since you brought up business and enterprise, like in interest rates as well, like credit squeezes, like the banks are turning off the tabs. They're saying, hey, we're not lending you any money right now, or less money, and at really high rates, like 8% and more probably. How is that affecting the business cycle, and how come we haven't really seen the cracks yet? Like it doesn't feel like, or at least it's not being reported, where like the businesses are faltering based on higher credit payments and interest payments.
Yeah, so I've written a lot about how most of macroeconomics, especially the equations that they write, are rubbish. And I call it physics envy. So physics has PV equals nRT, the ideal gas law. And monetarism has MV equals PQ. It kind of looks almost similar, but it's completely rubbish. It's not an equation. It's a post hoc, rationalization with a giant fudge factor in it called velocity. But there are macroeconomic laws, just not, necessarily appreciated by the mainstream. And one of which I just wrote about not too long ago, was R is greater than I. So R is return on capital, I is the interest rate or cost of capital. You cannot borrow at 10% to finance a business that's going to produce 8% return on capital, because you'll be out of business. Your payments will be, your Gazauda is greater than your Gazinta. So every time the interest rate falls, which had been the case for 41 years, 1981 to 2022, the interest rate was essentially a falling interest rate structure. Every time it ticks down, then that causes every business in the economy to reassess its marginal plans, plans to expand at the margin. So let's say you run a hamburger chain, you have 57 restaurants. You always have a spreadsheet in your pocket for the 58th, which you haven't opened yet, that's why that's the marginal unit. Because of either the demographics or competition or whatever, the bottom of the spreadsheet is red. Yep. You're not going to make any money. But one of the big costs that goes into the calculation is the cost of capital. They lower the cost of capital, you plug in the new interest rate, ding, red turns to black, and now you're profitable. So you build that next unit, thus dragging down the return on capital, not for the 58th unit, but all other 57 units, and 757 units of all your competitors. the return on capital across the entire hamburger industry has now been pushed down marginally above the interest rate. And the interest rate has been lowered systematically for 40 odd years. So they keep lowering the return on capital. Now we've just, boom, skyrocketed the cost of capital above everybody's return on capital, not just the margin, but way into things that weren't the margin and now suddenly are submarginal. Well, all of this stuff is headed to liquidation one way or the other, because the return on capital suddenly has to be not over 0% plus a margin, but now 8% plus a margin. That's an awful lot of liquidation. So people say, well, raising the interest rates is going to kill demand. That's true. But supply has to be killed faster and more in order so that you get supply down, in order so that you get prices up. I mean, the only way to get higher return on capital is higher prices. You can't get higher prices as long as all that supply is there. Supply has to be destroyed in sufficient quantities that even though demand is falling, supply is falling more, such that prices are high enough, that unit margins are high enough, that return on capital is finally above the new. This is massive, but it takes time to liquidate. If you're stuck and you're operating the unit and you still have equity capital to eat and other things like that, you keep going, hoping the Fed's going to reverse, because the game then becomes a game of chicken. Well, we know the Fed's going to, eventually have to react to the crisis and slam interest rates back to zero. So we want to be the guy that holds out while all of our competitors liquidate and we get a higher return on capital, rather than we go out of business to enable our competitors to get a higher return on capital. So that's playing out. Plus, when does everybody's rate resets depends on when they borrowed last and what the tenor was. So if someone borrowed 3-year money in January of 2022, they're sitting pretty,
They got a little wiggle room left, but
yeah,
not
exactly.
much.
And they're hoping that their competitors go out first and then ease the burden.
Interesting. I want to follow. It's like I think PMI numbers came out this week as well. PMI, I think so. I should have written that down, but you mentioned inventories and supply, and I heard that inventories jumped up again. Actually, that inventory is being built up. So in terms of that supply and demand equation, how does that factor in? Like, have you looked at that data? I think it came out earlier this week.
I'm much more interested in the dynamics of how supply is changing. Supply and demand, as people assess it, is a static, two-dimensional black and white snapshot. But reality is 3D and full color and in motion. So I'm interested in the capacity. When I'm talking about supply, I guess I'm using it in a slightly different sense. Of the capacity to produce, not how much inventory happens to be sitting there. So, and I'm not somebody who really follows PMI numbers and inventory numbers.
It's just something that popped up
My
this week.
question would be, we're heading into the Christmas season. Is that normal seasonality? Is everyone builds an inventory buffer because they want to sell for Christmas? Or is this abnormal? What would it look like seasonal adjusted? I don't know those answers, so I couldn't.
Okay, no, fair enough.
I wanted to go back to something else you said, which was, what is the debt being used for? So there's a statistic, and this is an old one. I didn't coin that. I've coined a few, but not this one, called marginal productivity of debt. And it's a little scary to me. If you Google that, you see a lot of my articles on page 1. I have somewhat of a reputation, but I'm not that prominent an economist. I shouldn't dominate page 1 on an old economics term like that. But no one else is using it, and they should be. So marginal productivity of debt asks the question, for each freshly borrowed new dollar of debt that we add at the margin, how much new GDP do we add at the margin? In other words, for each unit of squeeze, how much juice do we get? And as the lemon is being wrung dry, each additional squeeze, you get less and less until there's just barely a drop, and you're really straining with it. And so that is the measure of how much debt is going into non-productive things, including, if you borrow to consumer spend, you don't get a repeat. So you get a dollar of consumer spend, but after that, the debt hangs, and the debt keeps growing. So you have to borrow to service the interest on it, but you're not getting any more further GDP. So marginal productivity of debt has been falling since at least 1950. So it's Republican presidents, Democrat presidents, deregulation, re-regulation, every possible combination of cycle. And it only goes back to 1950. I bet it goes back more. That's just the oldest data that I've been able to find.
Interesting.
To calculate it. So this has been a very, very old and very structural problem. And what happens when marginal productivity gets below zero? Nobody asked this question. So I wrote an article called The Heat Death of the Economic Universe, looking at that question, what happens when you're borrowing more and you're actually decreasing GDP. It's very unsustainable. So getting back to the health
So
of the economy,
what's the end game there? How does that play out?
economic collapse of a sort more like 476 AD, not, I mean, we're having another 2008 coming, and I don't think we're near 476 AD yet, but eventually in the end, collapse. And this is obviously very dangerous, and we need to change course.
How can we do that, though? Just go following you down that rabbit hole now.
So the problem with the irredeemable currency, there are two fatal flaws that just cannot be addressed. And it's not a matter of the right monetary policy. When people say, what's the right monetary policy? I'm like, what's the right number? When the war on drugs used to be more prominent in the United States, every time you go to the men's room, the puck in the urinal would say, William Free, was the FBI director. And, FBI Director William Free says, don't do drugs. So what's the right number of urinal pucks to end America's drug problem? It's a wrongful question. It's begging the question. The question is presuming what it should be asking, which is, do urinal pucks really stop a drug problem? No. So what's the right monetary policy? Well, there isn't one. There's two fatal flaws. The first is the interest rate is totally unhinged in irredeemable currency. So we're using debt as if it were money. I mean, a dollar bill is an old archaic word for credit. It doesn't say on a dollar bill the word bill. It says Federal Reserve note. Note's another archaic word for credit. So we're using IOUs to pay debts, which means we're not paying off or extinguishing the debt, we're just shifting it around, which means the debt grows exponentially, right? So we have, 33 some odd trillion dollars of debt right now. I estimate something like 100 million people working in the productive, not for the government, because people working for the government can't, on net, pay off debt. They're being paid out, by increasing that debt. So 33 trillion divided by 100 million is $330,000 for every working person. And if you have a married couple that are both working, the aggregate debt on their heads is $660,000. Is there any way that could be amortized by the average couple's income? No way. So the debt grows exponentially. It's not a problem until it's a problem, as people say, but it's going to be a very, very big problem. The other problem, is the interest rate is unhinged. And when the interest rate is rising, you're causing mass liquidations, as I just described. Yep. When the interest rate is falling, you're causing massive, not only malinvestment, but consumption of capital. The consumption of capital comes via bull markets. So I buy a Bitcoin at 1,000, it goes to 20,000, I sell it to you. You're forking over $20,000 of your wealth, but it comes to me as income. Very, very dangerous. So I take my $1,000 of capital back because I don't want to spend my own capital, right? I have $19,000 of profit. Let's say I take 9,000, add that to my capital. I spend 10,000. I'm spending my profits. I'm spending your life savings. You wouldn't spend your own life savings, but we now have a market that is a grab bag where I'm spending your life savings, and every time the asset prices are going up, then we're collectively spending the aggregate savings, and falling interest rate is endless rising asset prices. So these are very, very destructive things. We need gold. The difference between gold and the dollar, yes, gold can't be printed. That's true. Inflation as such in gold. That's true. More importantly, you have a stable interest rate. Stable interest rate means stable asset prices. Stable asset prices means you don't have all of this non-productive. First of all, waste of energy and time. The most talented people go into speculating in markets, but you don't have borrowing to speculate. You don't have this incredible waste. And if I pay you a debt by handing over the gold coin, the debt goes out of existence. If I pay you $1, the debt doesn't go out of existence. I've shifted it. I'm out of the debt loop. Now the Federal Reserve owes you the money. Right? So it's a very different mechanic at root. And so the gold standard allows stability. We need to bring back the interest rate to gold, which is what my company's doing. I'm not trying to turn this into an advertisement. That's the only way we get out of this. There isn't any paper currency that can replace the dollar. There isn't any monetary policy that can fix this. We need gold. And that's why, of course, why governments killed the gold standard starting just before World War I is gold is a restraint on government. They can't really borrow the way they do today, and so they can tax only a certain amount before the voters, have a revolution. And so that kind of limits them to something much smaller than what we have today.
So are you saying gold is actually just not attractive enough? It can't compete because there are too many other instruments on the dollar or currency side that are stealing its thunder?
No, I'm saying
like yield, for example, as you said, like, so we have to make gold more attractive.
it's not that you have to make gold more attractive. You have to. So gold is, there's unlimited attractiveness to gold. Mankind has been accumulating gold for 5,000 years. There's no such thing as a glut.
No.
Every year the mines are going to put out 3,000 more tons added to all the gold that's ever been mined in human history. And people snap that up at higher prices. The problem is nobody brings the gold to market. A lot of people would be happy to be paid in gold. Nobody wants to pay out gold. So, the bad money drives out the good. So the only force that will bring gold into the market is interest.
All there is.
And so gold has to have an interest rate, which means gold has to finance production. So put yourself in the shoes of a farmer. And the same argument, by the way, applies to Bitcoin as well. But Bitcoin is disrupting finance, they say. It isn't financing anything. So you're a farmer, you need $1 million to finance the planting of the crop and the weeding and the fertilizer and the insecticide and all that stuff. And of course, your crop is going to come 6 months from now, but well, not today, November, but in March you'd have to borrow this money. If you borrow dollars, which of course is what they all borrow today, then you need to be paid dollars for your crop at the end, because that's what you have to remit to your creditor. Otherwise, your creditor takes you to bankruptcy court and takes your farm, and probably your house is on the farmstead as well. You lose everything. So you need dollars. You need whatever it is you're borrowing. So whatever the instrument of finance is what you need for revenues. If you finance in gold, then you'd want to get gold in the market rather than dollars in the market. So we have to replace the dollar with gold as a means of finance.
Is there a liquidity problem?
Correct.
In the gold market?
Yeah.
No.
Would you say there's enough liquidity to just sort of replace it?
More than enough. So the interesting thing about gold, liquidity can be measured by widening bid-ask spread. Gold is the one market where the spread doesn't widen. So the crisis of 2008, I distinctly recall a story of a guy who bought some famous old masters painting in 2007 when things were booming. He paid $13 million. I don't know if it was Picasso or Rembrandt or something like that. $13 million. In fall of 2008, he had a margin call or something. He had to have liquidity. He sold that painting for $100,000. Now, that's not that the painting was worth $100,000. It's that the offer on that painting was probably $12,500. The bid was $100,000. So the bid widens to 95% or whatever that works out to be. In gold, the bid always is, the bid offer spread in the professional markets is 10 to 30 cents, something like that. To put this all in perspective, back in the late 1890s, London ran the world's trade and the world's monetary system. Guess how much gold was in London officially at that time?
Well, good question. I don't have the answer.
160 tons.
Not that much then.
The state of Nevada produces 166 tons annually.
Yeah.
Now, in those days, things were less efficient because they didn't have computers, they didn't have phones. Even the mail was a lot slower. It had to be delivered by horse and train and, all these things today. Obviously, with email, now we could do things more efficiently. You don't need that much. What you need is a good clearing mechanism. You have to have a way for the gold to flow, and you have to have a regulator of how much gold comes into the market. There's essentially unlimited amounts of gold out there. How much comes to market is a function of the interest rate. So there's a story that I had read once, and I've never been able to find it on Google again. And it was one of the banking panics in New York. It might have been 1907, but I don't remember which one. It was one of the 1890s, it could be. And somebody supposedly went to J.P. Morgan, the man, John Pierpont Morgan. Mr. Morgan, there's a crisis. There's a shortage of gold in New York. What are we going to do? And J.P. Morgan said, raise the interest rate. 4%, he said, we'll draw it off the continent. In those days, it would have to go on a ship, which is a steamer. It would take weeks to get across the pond, and with some risk and everything else. 5%, he said, we'll pull it down off the moon. So referring to something that people would have understood in those days, the higher the rate, gold will come pouring in from everywhere. The lower the rate, not so much.
Yeah.
And so one of the things that I feel really privileged to be able to do we have what we call the gold yield marketplace at Monetary Metals. And not only have we seen that, yes, gold comes out for interest, but there's a proportionality to the interest rate. The higher interest rates, the gold comes out at a faster rate and more aggressively.
Yeah.
And the lower rate, it comes out, but it's a little more tepid. So it's all about the interest rate. And there's unlimited gold liquidity to finance anything at the right interest rate. And that's what, the market has to redevelop. That's been dead for 80-something years now.
Fantastic. Keith, we have to wrap it up here at this point. Like, we will have to do a follow-up because I want to dive a lot more deeper US dollar bonds and things like that. Maybe we'll do that before the year end. Give a bit of a forecast as well. But thanks so much for joining us here in New Orleans at the New Orleans Investment Conference here at our booth. And where can we find more of you, Keith?
My company website, monetary-metals.com. My Twitter is @RealKeithWeiner on Twitter.
Fantastic. Awesome. Keith, thank you so much for joining me.
Right.
And let's do the obligatory handshake here. And everybody else, thank you so much for tuning in to Soar Financially here from the New Orleans Investment Conference. If you haven't done so, smash that subscribe button, hit that like button as well, leave a comment. What do you think is happening? Would you give up your gold for a bit more interest? Let me know. Put that in the comments below. We want to hear from you. Thank you so much. We'll be back with more.